Welcome back to The Agent of Wealth. This is your host, Marc Bautis. Today, we're diving into the world of self-storage investments, a low-barrier, high-profit opportunity that's transforming the way small investors can create wealth. I'm joined by guest Mark Helm, founder of the Q2 self-storage brand, developer of the Storage World Analyzer, and best-selling author of Creating Wealth Through Self-Storage, a handy roadmap for investors to navigate the competitive self-storage market. A real estate veteran, Mark is a pioneer in the self-storage industry with over 20 years of experience. He's helped thousands of investors navigate the complexities of this market, leveraging technology and strategic systems to build wealth without requiring huge upfront capital. Mark, welcome to the show.
Hey, Mark, good to be with you. So thrilled.
So maybe you can start off by sharing a little bit about your journey and how you got into self-storage and that particular niche in the real estate investing market.
Okay, well, good. I really appreciate the opportunity to be here. I've listened to a lot of your podcasts, and you have a wide variety of people on here, and I'm just like honored that I would be in kind of that mix. So thank you. I woke up most of my life like a real estate agent. I obtained my real estate license in May 1, 1985. That was my last W-2 income, by the way. And quickly realized that I needed to be in commercial real estate and started gravitating towards that. In 1995, I obtained my CCIM designation, which is, I wouldn't call it a PhD, but it's like a master's degree in investment real estate. And a lot of the institutional buyers and sellers in commercial real estate work with CCIM. So I felt important to get that designation. And I'm within a few weeks of getting that designation, I was in my office and I received a phone call from the acquisition director of a then self-storage REIT. Now, at the time in 1995, I was primarily in the office business. I had a group of investors that I worked with. I would find office buildings, usually B class in our CBD area, Louisville, Kentucky. I would sell them the office buildings, and I had a management company that would manage it. And I was leasing and selling office buildings and managing office buildings. And I wore a coat and tie every day and ran some fairly sophisticated financial analysis software, and thought I was kind of hot stuff. I made a good living, but my lifestyle required a lot of cash going out. And then I got this call from this acquisition director asking me if I could help him find self-storage. And kind of like a hot tip, if you ask a real estate agent if they can help you find property, there's usually only one answer. And the answer was yes. And I went out with this person. I'm all dressed up in suit and tie, and he's in jeans and a shirt. And I'm running, the sophisticated financial analysis software, and he's got a little computer with an Excel spreadsheet. Now here he is. A REIT's kind of at the top of the food chain in whatever industry, you're in. And he's out here with a little laptop and an Excel spreadsheet. And I thought storage was a pretty simple little business for simple little people, I guess. But it didn't take me long to see what it was. Basically, it, for all practical purposes, is like a warehouse. It's an industrial building, metal walls, concrete floor. I had done a lot of flex space leasing in the Louisville market as well. Warehouse was, at that time, was getting about $3.50 a foot, $4 a foot in a new building. And I went out and looked at this self-storage, and what I saw was, back then, they were getting $9 a square foot for non-climate controlled self-storage. They were getting $10 to $11 at the time for climate controlled self-storage. What I saw was, unlike the office, retail, apartments, there really wasn't any tenant improvements. There's no sinks, toilets, carpet. The few capital expenses this REIT had were very predictable. He knew when they were going to come. And what I discovered was a small 12s back then, 12 cent. Today, I probably put in 14 or 15 cents a square foot per year reserve fund covers the capital expenses you'll need in managing your asset. No commissions. No, I fell in love with that product. Didn't take me long to see what it was. And I've tried to figure out how a guy like me could get in that business. And the one thing I could do at the time was I could find deals. So I found some storage deals. It took me a while. I closed on my first self-storage project December 31st, 1999. So that's how I got in.
And when you say project, was it an existing
Yes,
self-storage
sir.
facility, or did you actually build? You actually build
Yes,
it?
sir. It was built by a person in Bloomington, Indiana. He was big in the business at the time, although his main business model was smaller facilities. But in his hometown, he found a site he thought was good. He built, then it was 62,000 square feet, and he'd just done the last phase. And that was built but not leased. So I bought the facility literally 50% occupied, which was great because I could get some upside on that. But I bought the facility in Bloomington, Indiana, and that was my entry into the world of self storage.
And did you do it remotely, or were you living in Bloomington or close to Bloomington at the time?
Well, Louisville's probably a couple hours away. I spent, it was really fun. We closed on it, and I spent a month up there,
Okay.
learning, getting my feet wet, running the facility. Then I hired a manager to run the facility, and then quickly did a couple more deals. So we had a small portfolio going. I had enough funds to hire somebody to oversee the managers. Then I oversaw that person. And what happened was as quickly as I got into business, I raised money, we syndicated the deals. Um, as soon as quickly by 2003, 2004, we started receiving a lot of unsolicited offers. And the way I was organized, majority ruled. And I got out of the business with that first portfolio pretty quick when we started getting, you know, very high offers in like years three on the whole on a 10-year hold period that I above what I had projected by year 10. So we were getting very high offers. We ended up selling that, and it took me a few years to get back in, and I did my second building of a portfolio, much bigger, and I started in 2008 of all years. But that's when I started the process again.
But actually, that was probably a good time for self storage, right? As people had all housing issues and needed somewhere to put their stuff if they didn't have a house anymore or a place to live.
You'll hear people often say, or I've heard it said, that self storage is recession resistant. Well, nothing is recession resistant. It recession proof. It might be recession resistant, not recession proof. But what happened is, as an industry, we lost about 8% of our tenant base in 2008, which was comparatively very good. Um, and It actually created some problems for us in the self storage space later on. But during the recession, the '08 recession, we lost at the facility. I had one facility at the time, and thank goodness I did because I went 18 months with zero commissions. I mean, there were no CMBS loans going on in 2008, 2009. Most banks were, for a year didn't lend on commercial real estate, and but I was in the storage business, so I had some cash flow. And what happened was, from the commercial real estate investment side, there were three kind of shining stars that emerged in the '08 recession. One was medical office. That did well. The second one was, of all things, student housing. Student housing did well. And the third was self storage. Now, if you think of medical office and student housing, I mean, medical office at that time was probably $250 to $300 a square foot to build. Um, Student housing, who knows? I mean, those are like resorts almost. And then you had storage. I was building institutional grade self storage for $50 a foot. At $50 a foot at the time, I could build something that a REIT would take out.
What's the market look like now? Like when you mentioned when you first started, there was a gap between what an office space could get for rent versus what you could get per square foot in self storage. Is it the same now where there's a big disparity, or has it gotten more competitive? Is the market more saturated than it was back then?
Well, it's a lot different than it was back then. Uh, we've got challenges today, but I had challenges back then too. Main challenge I had back then was not many people use self storage, and not many banks like to loan on it. So there's always been challenges. But what happened is after Wall Street or institutional investors began to see how well storage can function in a recession, in 2010, I mean, money started flooding in the self-storage space, like a lot of other spaces, but particularly self-storage. A lot of funds were formed, REITs ate each other up, and a lot of capital flowed in. And when capital comes in, stuff gets built. You started seeing these monster 5-story, 4-story, 120, 130,000 square foot, 100% climate control buildings being built everywhere. And so there's now a lot of supply on the market. Um, Self storage is different than almost any other asset class because, how do I put it? It's very localized. In our portfolio, the average customer lives 3.2 miles from our facility on average. And if you're in smaller markets, rural areas, that's larger. That, it could be 6 miles, 5 miles. But in most cases, literally, you can send a drone up and see your customer base. So what's going on in Louisville, Kentucky, what's going on in Manhattan is interesting, but what's going on in your trade area is everything. What's the supply demand of your trade area? So it's we've got a lot more access these days to data. I can look at almost any address in the country and I can tell you what the current supply is. We typically measure that in what we call square feet per capita. How many square feet of self-storage is there per person in that trade area? Kind of like an average might be 8, although in some markets it can be as high as 10, and in other markets 6 could be, equilibrium. But on average, let's just say it's 8. So I can quickly look at a trade area. I can see what the current square foot per capita is. I can see what's in the pipeline that's could be built or getting approvals. I can also now look and see exactly kind of what the average rate's been for each unit type, climate control, non-climate control. So we're looking. I spend a lot more time looking at trade areas than I ever did before. Used to be you
Is
could
there
just build
is
it.
there is there like, so you mentioned that the data and all the access to data. You're really just trying to see, is there room for storage or need for storage, or is it saturated? But is the different areas, like maybe a level at in New York City is different than Pennsylvania, just because it's utilized different in different areas in the country, or is self storage pretty common across the
It's
country?
pretty common across the country now. At any given moment at this today, 10% of the population are using self-storage or have a need for it. In Manhattan, for example, given there's high barriers of entry for self-storage in Manhattan, so it is undersupplied. Most of Manhattan is now like conversions where you buy existing buildings and convert its use into self storage, and those do very well up there. In other areas, land is plentiful and less expensive, so buying existing and expanding, or buying or building new construction kind of is the way to go. It just depends on what part of the country you're in. But yes, there is still a lot of trade areas, a lot of places where there's undersupply of self storage. I looked at one last week I'm all excited about in Florida, where the rents were, believe it or not, $20 or so a square foot for self storage, and the current supply was 4.6 square feet per capita. I mean, like that is an area that's just like, I want to be there.
Is that the first thing you do when analyzing or kind of figuring out where you want to do your next investment? Do you look at the data, or do you look at a particular deal or particular property and then see if the data behind it
Both,
fits the deal?
both. Kind of, I do a lot of training and working with people, but usually what we do is I start by showing how to analyze self-storage. It's a little different than anything else. So if you're looking at an apartment complex, or you're looking at a shopping center, or an office building, we would always start with the rent roll. And you don't do that with self-storage. You start differently. You start with the unit mix, and I teach what the numbers are on self-storage, operating expenses, how much storage you can get per acre, that type of thing. And very often what we do is I start with looking at existing property. It's hard to buy existing property today and just buy it, tweak it, improve the management, and get anything near the returns that we need to get as small investors. So usually where we start is I look for property that you can expand. I've done a lot of expansions where you'll buy 25,000 square feet, then I'll add another 25, 30,000 square feet. I now have a product that a REIT would look at on an exit strategy, and I upgrade the facility and kind of bring it from the 1900s into this century. And I've done that quite a bit. The other thing I've done a lot, and we've done real well at, is buying existing buildings and converting them. And we've also done ground up development. But the conversions and the expansions I like because they're quicker. And even in conversions, I can get rental income. I'll rent part of the building out, even if it's just warehouse at $1 a foot or something, or I'm putting parking cars in there. I'll get some income while I'm in the lease up period of my self storage. And with expansions, you've got the current cash flow from what's there helping you as you do your lease up on your expansion. So I really like to start there. Then, if we're looking at a project, but we love the area and it does, but that project doesn't work, which is quite often the case. That's how I found this area in Florida. Then we start looking for land opportunities or conversion opportunities in that particular market area.
Now, like in this example that you're giving in Florida, let's say the project doesn't work, but you look and you find a conversion opportunity. How do you, like, do you have to go find a local team to help build, help execute on this conversion?
Well, it depends. If I'm working with somebody who has zero construction experience, yes. In fact, we have. I didn't really want to do this, but I ended up having to do it to solve my own issue. But I brought in a general contractor who's got national certification, and we go state by state to get the state certification as a GC, because lenders today, when I was doing it, I just functioned like a construction manager. And if it was far away and I couldn't be there, I would hire a construction manager. But I was the guy, or my team was the people that would pick the fabricator, pick who's going to put the building up, look at the contracts from the plumbers and the electrical, and we executed all that. And then I oversaw it, or I would have a construction manager oversee it. Today, lenders are requiring GCs, and so as interest rates went up and construction costs went up, I ended up having to form a construction company, basically do my projects, and then we also support people kind of in my world, my sphere, that are smaller investors doing expansions, ground up, single or double story, and conversions. So, but for the most part, how I operate is I would hire a construction manager, and then I would kind of make the decisions myself. Fortunately, in the storage business, the companies that fabricate the storage systems provide a lot of services. I usually get engineered plans on the building. They give me site layouts that I can give to an engineer to work up. So my cost of planning and development is a lot less, kind of using the process that we use, rather than just going straight to an architect and say, I want to put 50,000 square feet on this, 5 acres. So I'm real fortunate that it's storage. I couldn't do that process with any other asset class other than self-storage.
When you're working with someone, and let's say it's the first time, someone who's getting into self-storage for the first time, how involved do you get? Because I'm kind of thinking of this from like the bank or from the lender, and I would think they would be hesitant about lending to someone who's first time and looking to do a conversion or a build out or something, and not even being local to the area that they're trying to build. Are you heavily involved in the entire process?
Well, that can be an issue. That can be an issue. Now, a lot to, like in anything in life, your success to a large degree is going to be a function of your team. I'm just like a consultant or a coach on the team. I train people on how to analyze, how to find, how to do deals. And then if they need, other services, I can guide them to people who can provide those services. But when we go to a lender, we're not just like, by the time a client, somebody I'm coaching or working with gets to a lender, I mean, they have a plan. They know the numbers. They know they have an independent third-party feasibility report that's part of the team that shows the supply demand for that trade area. They've got cost on what it's going to cost to buy, build, convert, and very often, if the lender says you need a GC, we'll get them a GC. If the lender says, I don't want you to manage because you've got a W-2 job in Fort Wayne, Indiana, and you're building here in Wichita, Kansas, then we'll get a third-party management company in there for them. All that's priced into how the asset's going to operate. So depending on the person, what their skill level is, what their involvement is, we tailor how we present to a lender now. Typically with lenders today, they, if we're doing construction, expansion, or conversion, they're looking at what's it going to be worth when it's stabilized. Stabilized occupancy in the storage business is on the low end 85, kind of on the high end 90%, although historically over the last few years it's been above 90. But banks are going to underwrite it kind of 85 to 90. We underwrite it 85 to 90%. And we make sure that the debt coverage ratio, when stabilized, is at least whatever the bank wants, usually like 1.2 to 1.3 debt coverage ratio.
And just talking a little about the management, let's say when it is stabilized, What is that? And most people they know what like a property manager for a multifamily house or something like that. What's involved with that? What's involved in the actual management of a self storage facility?
Wow, that's a question. So first of all, it depends. It depends on what type of self storage you're building. Um, Today, there's a lot of smaller automated facilities. Um, One of the reasons REITs like 50,000 square feet or more is because there's enough economics there to hire managers. Um, I tell people that running, self storage is a real estate play, but it's really more like building a strip center and then opening the store inside the strip center. It's an operating, ongoing business. It's not a complicated business, but it's an operating business. If people want to manage their own, we manage our own facilities. Um, and there's key performance indicators that you keep your eye on monthly, quarterly, yearly. Um, I always know, for example, I want my income as a percentage going up more than my operating expenses as a percentage over time. Try to do it yearly. There's a lot of things you got to keep your eye on. But I will say that storage has more dials and levers than an owner can pull to affect the net operating income than anything else out there. Our leases are basically month to month. With a 30-day notice, I can raise the rent. I can add other income streams. Apartments, flex buildings, uh, most commercial real estate, investment commercial real estate, your income's pretty well defined by your lease. That's not the case with self storage.
If we look at the financing aspect of it, I assume with like most things in real estate, if you try and go at it alone, eventually you're going to run out of your own capital to use. Do most people, as they're trying to build a portfolio, eventually get to syndication? Is there opportunities to trade up these self storage facilities to like same way you would maybe start with a four family and kind of work your way up to an apartment building? How do people usually progress to build a portfolio?
Well, everybody's goals are a little bit different. Some people I work with come out of the chute wanting, like I did, wanting to build a portfolio. And you quickly run out of, or I quickly ran out of my money, so we ended up syndicating. Um, some people I work with want to build a portfolio, but it might be five or six, and they don't want partners. So they're doing it themselves. Some people want to buy one or two, kind of run it, get extra cash flow, but it's primarily a retirement vehicle. I've worked with some people who take all the excess cash and a profit in a year, net distributable cash, and in each year they pay that loan down so that when they retire, they're free and clear or close to free and clear. So there's a lot of strategies based on what your immediate goals are and what your long-term goals are. But quickly, with kind of the numbers, the zeros, and everything involved in storage, a lot of people get into syndication. Some get into literally creating funds, um, you know, blind pools of money where they can go out and acquire self storage based on certain acquisition criteria. Um, but there's a lot of ways to enter it. I would say at least 50% of the people I work with are involved in syndication.
Yeah, so that's kind of the prevalent way of at least getting to a
It
bigger size
spreads you
portfolio.
across more markets where you're not tied into what happens in one particular local economy, and so it spreads your risk, and it gives you the bandwidth on the management side to be able to run a business pretty effectively.
Yeah, but I guess there's other challenge. There's also new challenges when you start taking in people's money and syndicating and doing
Yeah,
things like that
it's
as well.
it's yeah, you've got to if you're an investor and actually investing in a syndication. with a seasoned operator is not a bad way to get in the storage business. Some people, that's their entry point, and then they kind of get a feel for how what that syndicator's doing and how they're running their business. And then I've worked with a number of people who invested in my deals and other people's deals, and then I work with them to go out and start, being their own sponsors.
Yeah, and I guess how much I guess visibility do they have into that? Because so you see some people in real estate, it seems sexy to be a real estate owner, and then they own a property, and they're like, "Whoa, this is not what I wanted to do." Do you think they get a feel for that through like a passive syndication?
Not totally,
or
not totally, but it depends on the sponsor. It depends on how well the sponsor communicates what's going on, the decisions they're making. And I've seen some sponsors who are fantastic at it, and I've seen others who aren't. So, and I invest. I don't invest in other storage sponsors, but I've taken money off the table from assets we've sold and invested them passively with sponsors and other type of asset classes, just now to spread my risk out a little bit. But I also have done it to see what they do well and what could be improved. So as a sponsor, I can improve in communication with our investors. But I'm not big time. I mean, I don't run a fund. Don't want to. Got close a couple times, but elected not to do it. For some specific reasons, but I still do kind of one-off deals. I'll put together, I call it country club money. Everyone who's ever invested in one of our storage projects or in more than one of our storage projects, I know, I've talked to, gotten to know them. And that's just kind of the side of the street I tend to walk on.
If an investor is thinking about investing in a passive, whether it's syndication or fund, what's a red flag that they should look at? Because if you look at it like you look at a pro forma on the multifamily side, and you get it from a sponsor, they all look great.
They do. They all look phenomenal, don't they?
But what's something that I guess that they miss, like the investor who doesn't have a lot of experience evaluating self-storage facilities, what should they look at, or what do they miss when they're looking at, a pro forma from a particular deal or opportunity?
Well, this could be in any asset class, but one of the things I would suggest they do is ask that sponsor, how do you handle surprises? Because I'll promise you, there are surprises. And every deal I've ever done, I always wish I'd done something different. There is no transaction, no project I've ever been involved in, I didn't make some kind of mistake. The game is not to make a fatal mistake. And I would ask them how they do that. I would also look at what's gone full cycle. When I mean full cycle, what's been bought, value add, held, and sold. And look at the full cycle, look at the returns that have been generated from those projects that have gone full cycle. And then look pretty close at some of the assumptions that are used in the pro formas. So one of the reasons I particularly didn't want to do a fund is I live and die by the returns that each project makes, because I have investors that are in one project only, and then I have investors in multiple projects. So I personally, it's not like every project I've ever done exceeded my pro forma. Couple haven't, most have, a couple haven't. But what I began to see, especially with guys with funds with $50 million, they got to roll out the door into self-storage because that it's costing them money to have it sit there. So they would start doing deals, and frankly, a lot of the fund people make a lot of money on the transaction itself, not on the returns that the assets generate. So what would
Right.
happen is you would see five caps on reversion sales. So in other words, the value in year five was whatever the net operating income was, they applied a five cap to it. They would apply, that's all you got to do. You want to improve your performance and improve the IRR, reduce the cap rate, increase the income growth each year. So I would look closely at those. Today, I'm using maybe in a like a tier one market for reversion cap rates. I'm using 6.5 to 6.75. If I'm in a tier, smaller market, if I'm in Pensacola, Florida, I'm using a seven cap for future value determination at this point because I don't know what cap rates are going to be, 5 years from now. I'm not going to assume they're five or six.
Yeah. What do you see in some of the trends in self storage, whether that's in like analyzing or investing or the actual self storage, the operation of a self storage
Well, the
facility?
biggest challenge as a small operator and investor that I have today is the fact that so when I met this acquisition director in 1995 and took him out and showed him self storage, he told me his comment was self storage is a pretty boring industry. He said the biggest innovation we've had is the advent of climate control. That was like the breakthrough. It's not the case today. This industry is evolving rapidly. And probably the biggest evolution over the past few years has been the introduction, starting with the REITs, and it's kind of worked its way down the food chain of dynamic pricing. It's pretty much like an airplane ticket or like a hotel room. So our operating systems today have algorithms that can pull in data of what, um, like in your trade area, how many 10 by 10s are there available? If all the 10 by 10s in your facility and in the trade area are, let's say, 92% occupied, the rate goes up. I mean, you set it however you want it. So rates are constantly moving up and down. And today, as more product came on, what the REITs started doing is lowering and lowering and lowering the entry price to get in. And then it's nothing to have a 30, 50, 80% increase in your rent within less than a year. And so as we look at what are the rates in a particular trade area, what you're often seeing are what the entry rates are, but you don't always see what the in-store rate is, what the actual income that's being produced by a 10 by 10 in that facility. So fortunately, some of the new software coming out will kind of give us averages of what a 10 by 10s or whatever size has been over the last 12 months. But that's like a big challenge today as a small investor. And we've got to educate often lenders about what's going on. They'll look in a trade area and assume that $70 a month is the average 10 by 10. You got to say, no, that's just their entry point. Here is what's really going on behind the scenes. And you got to show them.
Where's all that data come from? Like, if you own a storage facility, are you reporting your rent data, your occupancy data, or are they obtaining, is that data coming from somewhere else?
Good question. Primarily, the data comes from institutional owners. Um, they So there's been a lot of consolidation in the self-storage industry, and there's two or three kind of major providers of operating systems. So some of these data platforms that aggregate information not only scrape the websites of public storage, extra space, whatever storage is in that trade area that has a website, they're also going behind the scenes to the provider of the operating system, trying to scrape as much data off there as they can.
Yeah, makes sense. All right, Mark, that's all the questions I have for you today. I want to thank you for joining me and sharing so much valuable information about self-storage. Before we go, where can listeners learn more about what you do or get a copy of your book?
Amazon. I have a website called creatingwealththroughselfstorage.com that has a lot of free training on it. I also have courses that are online, cloud-based, that you can also purchase out of the store there. If you want to move further, you can also contact me through the website. You can also, my email is mark@helm, HELM, properties.com. And, if you want to reach out and ask questions, feel free. I try to be as transparent as possible. Share what
Great.
I know.
All right. We'll include all that in the resources section of the show notes. Thanks again, Mark, and thank you to everyone who tuned in today.
Thank you, Mark.